Welcome. We begin a little bit with the discussion of Bitcoin. It's gone to the moon, in fact, certainly.
Yes, good morning. By the way, I'm hearing the music in the background. I'm not sure if that was intentional. Okay. So yes, it's been another interesting week, week 3 after the election. And the markets in general, I think, have been relatively calm. I mean, it's a continuation of what we saw in the first 2 weeks. So a broadening, stronger dollar, less expectations of Fed rate cuts. The bond market is fairly well behaved at this point, but certainly the big news last week was Bitcoin, knocking on the door of 100,000. And when I went down the rabbit hole 4 years ago on Bitcoin, I did have 100,000 plus, in the models. I think I had said by 2023, so we're a year later. But still, it's pretty remarkable to actually see to see that right around the corner potentially. And it's interesting, if we go to slide 19, obviously there's a crypto-friendly administration coming in. Although it was kind of funny to hear Robert Kennedy Jr., who of course is going to be part of the Trump cabinet, talk about how Bitcoin should be a strategic reserve in order to combat whatever loss of purchasing power or whatever reason he gave. And I found that
Treasury, though, is that right? At the Treasury?
Yes, which is another thing I'm not quite sure of, because I think it would be the Fed. But that aside, but for an administration to say you need a hedge against its own fiscal, shenanigans is a little ironic. So I don't know how much of this is hype. I think a fair amount is, but I'm on the record as a Bitcoin believer, but just to show that there's a lot of momentum here, and part of it is kind of the MicroStrategy story, which continues to issue debt and equity to buy Bitcoin. And I think a lot of people have jumped on that bandwagon, either through the options market or page 19, through the ETF markets here in the US. Those ETFs, of course, or ETPs as we call them, were launched in January. And you can just see the dramatic adoption that has taken place in those ETFs. But it's also the futures market on page 18. The open interest in the futures market is also soaring. So I don't think that this is entirely real adoption, and it's in part just people jumping on the momentum bandwagon and hoping that the next administration is going to be crypto friendly, which I think it will be. But how much of that accrues to Bitcoin as opposed to stable coins and blockchain innovations, that of course remains to be seen.
It is fascinating, as you say, to see it at these levels and in the period of time. To what extent, I guess you sort of want to ask if there's a bit of a top here, if this is getting taken along by momentum, as you say. You want to be careful with things like that, but you also wonder if some people look at this as, what's the timing in this between now and inauguration, for instance?
Yeah, you do want to be careful. Like if you're going to go into Bitcoin, you need to have done 100 plus hours of due diligence on why you believe this is for real, because you're going to have to stomach some real volatility, which always happens, and it will happen again. And if you're just playing it for a trade, then it's a trade, and you need to be ready for all outcomes there. So always caveat emptor there, but surely there is a sense that the previous or the current administration, I should say, certainly tried to regulate and hold back innovations in the crypto space. That's pretty clear. Although Gary Gensler did approve the ETFs that came out almost a year ago. So the Bitcoin space and even Ethereum, which was also approved, are sort of sanctioned as sort of legitimate assets, right? Otherwise, they would not be approved. So in that sense, they already got the seal of approval. And now it's just a question of, it's more of a question of sort of financial deregulation, And what happens to blockchain. And I think the likelihood of stablecoin regulation, I think, is now much more forthcoming. And I think that's very good because stablecoins have a real use case. And actually, it perpetuates the dollar's reserve status because it just makes the dollar more sort of democratically available in the distant reaches of the world. So in that sense, there are a lot of reasons to move forward with this.
You talk about King Dollar, and I wonder if we'll bring that in just a second. But I did want to ask you a little bit about sort of the pre-market, the weekend market reaction, not during an open market, to Besant being appointed. It was a little bit of a long-awaited announcement. Discuss, if you would. There seems to be a discussion of a slightly moderated tariff narrative there, but actually a bit of austerity to cut deficits pretty much in half. I mean, that would hurt, would it not? Can you just tell us a little bit how that would hurt?
If it's done through austerity, it would hurt a lot. And so again, there's so many headlines and it's hard to know what actually will happen. The market definitely is looking at all of this as a glass half full, right? So in the perfect world, right? So you got Trump and the red wave. They're going to deregulate the economy. They're going to extend the tax cuts, maybe even create some new tax cuts. Although it's worth remembering that requires congressional legislation. I heard someone tweet. Yeah, you know what? The Elon Musk is just going to cut all the taxes and make it a flat tax, and I'm like, okay, that requires Congress, and the DOGE, the Department of Government Efficiency, has no statutory power. So people are kind of connecting dots that are not necessarily there. But having said that, the idea, and I think what Bessert is referring to, is not necessarily austerity, because there's very little in the budget that is discretionary, right? Like Elon's talking about $2 trillion. There is not enough discretionary space in the budget to do that. But what you could do is you could grow, increase growth so that you can grow out of debt, right? So people measure debt as debt to GDP mostly. So if the denominator, nominal GDP, which includes both inflation and real growth, go up more than the debt, then you're growing out of the debt. And with animal spirits, capital formation, tax cut extensions, deregulation, you can paint that picture as long as you're not undoing it through either tariffs or mass deportations, because one of the reasons the Fed has been able to balance the labor market is because the supply of labor has gone up. You know this in Canada. You've had a very large increase in the population. It's not as big as per capita in the U.S., but the supply of labor has gone up. People have returned to the labor force, and companies have not really laid off anyone. If you start removing people from the labor force, then that could be, inflationary, of course, and it could upset that balance. So, there are plenty of ways that this can go off the rails. There always are, and I'm not suggesting that that's going to happen. But you always have to really think critically about these things and weigh all of the moving parts that can take place.
If we go back exactly to some of the markets and the animal spirits that you're talking about, this sort of bullish broadening continues. We see it in a lot of different stocks themselves. And I think you make the differential between sort of the top 10, which have powered much of this year, but also the other 490 on the S&P 500 that have been broadening, if not consistently, certainly throughout the second half of the year. Bring us up to date there. This overall bullish story continues.
Yeah, and it has been a good story. So slide 2, we'll go there first. That shows the top 10 and the bottom 490. So it's not quite the top 7, it's the top 10, just because that's how we deconstruct indices. And you can see they're both at new all-time highs, or at least near them. And they're both in well-defined uptrends, higher highs, higher lows. You can see, of course, that the slope is not the same. Like the black line, which is the top 10, has been rising at a steeper slope. So there is still a relative performance story there where the mega caps are growing faster than the rest, but the rest is moving, right? And we talked, I don't know, a year ago about the generals and the soldiers, right? When the S&P made a new all-time high in January and what kind of momentum that usually brings. And certainly that's turned out to be correct. And I was saying, the soldiers will follow, and that's exactly what's happened. And just looking at that a different way, if we go to slide 1, this chart shows the percentage of absolute new highs. So the number of stocks making new highs, those are the orange bars. And then the relative new highs, where the relative performance makes a new high, is in the purple. And for a while, we had this dynamic where absolute breadth was positive, but relative breadth was horrendous. So it was really just, if you were not in these 7 stocks, you were not participating. And that's now changed. So the number of new highs is very robust. And the relative number is sort of neither here nor there, but at least it's not an impediment. So the breadth story is really good. The market has broadened, and we've talked about this in recent weeks. It's kind of like the Benjamin Button market, where a typical bull market starts broad and ends narrow, because the broadness comes from stocks that were like obliterated in the previous bear market, and they come back really strong. And then towards the end, only the really big quality blue chip stocks with strong balance sheets are left hanging. And this has been the opposite, right? The first year of this bull market was narrow, and it was just these stay-at-home stocks, and then that morphed into these companies are immune from Fed tightening because they have a lot of cash, and that then morphed into the AI trade. But over the last year, the market has really broadened, even though it's now in its 3rd year, and that's a really good story.
It's a really good story, and it takes you, which is something you addressed a lot last week, to sort of the valuation story and kind of the sustainability ultimately at these levels. Earnings have been good. You mentioned there's been a lot of weight that's needed to be put on the earnings story, and it's all delivered. But multiple, valuations are kind of their own story. They're high.
Yeah. So if we go to slide 11, and this is sort of where I maybe throw some cold water on the notion that 2025 is going to be like 2017, which was, of course, year 1 of Trump 1. And this is 25 is going to be year 1 of Trump 2. In 2017, of course, we had the tax cuts, the TCJA. So earnings were really growing, and the market had not, excuse me, not priced in a Trump win at all, right? I mean, it was supposed to be Hillary, and no one saw it coming. So there had to be a significant repricing there. And so in 2017, we had both valuations go up and earnings go up. That usually doesn't happen. It does happen sometimes. And of course, that's what's happened in 2024. So you've had this double-barreled rally, because obviously if earnings are growing, that's key. That's the foundation for a bull market. But if valuations are also expanding, it amplifies what otherwise would just be an earnings cycle. And so in 2024, we've seen exactly that. But at this point, even though the equal weighted PE is still reasonable at about 1920, the cap weighted PE is pretty up there at 26 or so, trailing 22 forward. And so to expect another outsized year next year, like 20, 30, 40%, you would need a lot of help from valuation. So the earnings story is fine. Actually, we can pull up slide 13. Earnings are on the path to grow 10% this year. Right now, the expectations for next year is 13%. That'll probably come down a few points because that's what typically happens. But even then, let's say we have 10% earnings growth next year. If valuations don't contribute, then you just get that 10 plus dividends, so you get 12%, which is fine. That's historically average, but it's not like let's go have a celebration. So in order for it to be more than that, you need the PE to kick in again, even though it has already kicked in a very big way. And that, I think, is going to be a harder hurdle especially if the term premium, the long-term interest rates are now sort of pushing north. And I think another risk that I'm not hearing much about is that, so the Fed obviously was tightened policy to battle inflation, and inflation was at 9% in 2022 for the CPI and about 6% for the core PCE. It's winning that battle, right? Core PCE is down to 2.7. But in order for the longer term averages of inflation to go back to a 2% target, after overshooting to the upside, they need to overshoot to the downside in order to get the average in line. I mean, that's just the way the math works. And so the Fed got from 6% down to 2.7, which of course is above 2. And like the 2-year average, the 5-year average are at 3 to 4. And now we're getting potentially to a point where the economy is going to go on all cylinders again, right? With the election and capital formation cycle. So it's entirely plausible, especially if there's a big immigration story as well, where people are removed from the labor market, that inflation is going to come back up before it had a chance to really get put back in the bottle, right? Like in terms of the genie being put back in the bottle. So that is one risk, and that of course feeds into the long end of the yield curve. And that again, and this is a long way to answer the earlier point, that again could hold back the amount by which valuations in the stock market can expand, and therefore, contribute to another kind of 2024 like return where both the PE and the E are contributing. So that's kind of how I'm thinking about the puzzle.
It's really interesting how this also, I mean, it's been such a bullish time. You've walked through sort of where we've gotten to, and yet this story of cash on the sidelines seems to be pervasive. Some money sitting in money markets still. Is that a sign of things are too expensive, which you've just sort of laid out one of the cases? People could look at it that way. Or is it fear?
So let's go to slide 8, and I'm glad you asked that, because I've been sort of a hardliner on the front where this notion of this mountain of cash on the sideline that is going to get deployed in the stock market. I really didn't buy that argument for the simple reason, you can see it in this chart here, the black line, for the simple reason that as a percentage of the market cap of the stock market, cash is not really high. I mean, it's high in absolute terms, it's 7 trillion, but the stock market's like 60 trillion, right? So the black line sort of oscillates around 10%, and when there's a lot of panic, more cash comes out of the market and goes onto the sidelines, and that happened during COVID, for instance. And then that ratio goes way up. And then when there's a lot of animal spirits, the ratio goes down. So I was like, well, cash really isn't giving a signal, but I've come around to that, because if you look at the orange line, which is the high yield credit spread, that is at very tight levels, 265 basis points. And maybe that's way too low. And maybe the signal is that credit spreads are too low and not that cash is too high. But if you look at the two lines, they are perfectly correlated until the last year or so, year and a half. And so if the cash on the sideline, or I don't even want to say on the sideline, but if cash in money markets is going to navigate towards where credit spreads are, which is of course a risk appetite indicator, then the cash could actually go down by several percent, right? It could go from 10% to 8%. And that's actually worth over $1 trillion of potential buying power. But my sense all along has been that the cash in money markets hasn't come out of the stock market. It came out of the banks, because the banks even today are paying 0.5% on their deposits, and money markets are 4.5%, and they were at 5 or 5+. And so to me, there's more of a signal that this is just people with checking accounts looking to put their money to work, rather than escaping from the stock market's volatility and hiding on the sidelines. But there is some powder there. It's just not as big as maybe it looks at on the surface.
And as you say, in absolute terms, it sounds, well, it is massive. It sounds massive and it's massive, but when you look at the percentages as you've done, it's a different story. A little bit on yields. We haven't talked about inflation, actually, it feels like, in a long time. And the question marks seem to still be out there a little bit. Bearish steepener, looks like yields may be stickier, may stay higher. I don't know. There's lots of questions about the Fed. We're going to get some minutes and so on, but it doesn't look like we're getting down to low yields at any point. Bring inflation into the story, in the picture for us.
Sure. So that's slide 17. Yeah, and I think one of the stories for 25 is going to be the stickiness on the long end of the yield curve. And already here in the US, there's some sticker shock. People thinking that their mortgages finally were going to become more affordable now that the Fed is in a cutting cycle. And of course, the curve has bear steepened, which means that the Fed is cutting, but the long end is going up because the risk premium on bonds, that's also called the term premium, is rising, as it well should be, because inflation is above target, and we have fiscal, deficits as far as the eye can see, and that's only going to potentially get worse under the new administration if the tax cuts are extended and they're not paid for, and maybe they will be paid for somehow. I'm not sure, but that's the thinking, at least. And so the curve is steepening, but in a bearish way. And so mortgages, of course, long-term mortgages are tied off of the 10-year, and so there is that offset, at least in terms of the consumer. And I think the other element of this is, again, inflation's gone down to 2.7. It's proven to be relatively sticky there. 3 is the new 2 has been what we've been talking about all year. And it's entirely plausible, as I was mentioning earlier, that we're not going to make much more progress towards 2. And it's not the end of the world, right? 3% inflation. The stock market is totally fine with that historically. But it may prevent the Fed from easing further, especially as it sees this fiscal wall, heading towards it. And when we look at the Taylor rule, which I showed last week, I don't have it this week. The Taylor rule says that the Fed is exactly at the right level right now at 4 5/8, right? So the Fed really was not justified still being above 5. It should have cut. It did cut. It did the right thing. But going forward, if the Taylor rule stops making more progress in terms of telegraphing lower rates, and the 2 inputs in the Taylor rule, the 3 inputs are the natural rate of interest, or R star, plus an inflation component, right? So the gap between targeted inflation and actual inflation, and then a labor component, the gap between the actual unemployment rate and what's called the natural rate of unemployment. If the natural rate of unemployment if that employment gap starts to move because, again, immigration policy, or if inflation stops making progress, then the Taylor rule suggests that maybe the Fed needs to stop here and just be done with rate cuts. And the bond market is kind of leaning in that direction. So it may very well be that the Fed doesn't cut rates anymore at all. And again, not the end of the world. The economy didn't fall off a cliff at 5%. It's not going to fall off a cliff at 4.5%. But it's less good news from the funding side, from the discounting side of the valuation story. And it's yet another reason why, valuation, it's going to be hard to do a repeat of the valuation expansion that we saw this year.
Okay, really interesting. Question rolling in. This is back to politics, back to how we kind of began the discussion. So what are your thoughts on how potential tariffs may affect market growth?
Yeah, I mean, again,
depends on which market.
This is one of the unknowns, right? Is this just a hammer that Trump is going to carry around when he goes to G20 meetings and he says, give us better deals or we're going to slap you with tariffs? Or is there actually going to be a global tariff of 10% or whatever? And unless you're one of the good guys, which of course includes Canada, hopefully, then you're gonna pay more. And the people who are going to pay for this, of course, are the American businesses. It's not China who's going to pay for this. It's the American businesses who import stuff from China. And then it's a question of, do they pass this along to the consumer? In which case you have inflation, or do they eat it, in which case it affects their profit margin. And now maybe their profit margin is rising for other reasons, deregulation, taxes, stuff like that. So it doesn't have to be a zero-sum game, but it's a potential offset that either affects the inflation rate or profit margins for businesses. And I think everyone is sort of holding their breath with fingers crossed that this is just, a blunt negotiating tactic and not much more. But, Trump did raise tariffs in the first administration, and that is it's a bipartisan thing, right? The Biden administration continued them, and they're still in place. So we'll see. And one other added element is, now Elon Musk is sort of, the first buddy in the White House, and he has a massive operation in China. So like, where does he fit in? Will he be able to open some diplomatic doors, in China while there's a lot of bluster going on the surface? So there are a great many unknowns at this point.
Okay, yeah. I mean, it really is going to take a bit of time to sort all this through.
Yeah.
Shall we end on the dollar? Just a little bit about our little loony is really feeling squashed, I got to tell you, for other reasons as well. But let's talk about, I think you put it as King Dollar. How's the rest of the
so slide 16. So it's been a remarkable story. The dollar has gone from the bottom of a very long trading range to the top in a matter of a few months, and so it's been very strong. There of course are many drivers, but one, ultimately I think the biggest driver is that currencies are driven by interest rate differentials, right? And of course the Bank of Canada went pretty hard at 50 basis points a few weeks ago. I think I was in Toronto at that time, actually. And now the Fed potentially is going to cut less than expected, or maybe not even at all. And the yellow bars in the bottom shows the difference between where the Fed is expected to be in a couple of years versus where it is now. And you can see as those yellow bars wax and wane, the dollar kind of follows, which makes perfect sense, right? So the Bank of Canada is easier, the ECB is easier, the Bank of Japan's kind of doing its own thing. But if the US is really going to have this whole new robust expansion with less Fed cuts, more growth, then the dollar, would be higher in that scenario. And at some point that can start to bite, right? I mean, the dollar is one of the components of the financial conditions index. And so a rising dollar generally is not a great thing for markets. I mean, it hasn't really held them back this time, but it's a terrible thing for emerging markets, right? Because emerging markets tend to fund themselves in dollars, and therefore EMs are basically short the dollar, so they're getting squeezed by this rising dollar. And nobody really wants a strong dollar. I mean, kind of Trump wants it, but I think Bessert, the new Treasury head, he wants a weak dollar, right? So who knows how this is going to play out. But right now, the capital is coming here because rates are higher and are likely to stay higher, and because growth is likely to be better.
It's exciting times in the markets. It really is. It's fascinating. So glad that you're there to sort of steer us through. Jurrien Timmer, we'll see you next week. All the very best.
Yep. Thank you very much.